Aspetta, questo sicuramente.
Let me see if most people is here. I think Dr. James John's here. Let me see if Allison's here yet. Allison haven't got in yet. Allison's probably still in the meeting or something. Let me give her a call.
Okay, bye, doctor. Bye, thank you.
Amanda, I can hear your voice.
You can hear me?
Of course I can hear you.
My staff are leaving. I didn't know I didn't turn off the
That's
audio.
okay. That's okay. I think you close your background.
I did. I can turn my.
Now I can see you. Fancy background.
Let me do my fancy background.
Fancy background. Yes.
Where's the recording docs notes whiteboard?
It usually is in the is in the background part.
Where's the background?
I tell you what.
Harold?
Yes.
I think we can start.
We can start? Okay.
There are 20 more people. Let's get started.
Okay. I noticed that Allison haven't got here yet. So she told me she just finished in the, I think, city hall or something like that. She have like a meeting in the city hall. And then she just finished up. So I just sent her the link in the group chat. She's just finished the meeting in the Redmond City Hall. So I told her she should jump on. Okay, let me just tell her to jump on. Okay, so let's get started. It's my great pleasure to introduce Chris and John. They are brothers. They've been with the Levine Group for quite a few years before they branch out for themselves. Levine is one of the, I guess, one of the early on people that do a lot of practice management. I think many years ago, he's the first one who to practice management, I believe, if I'm not mistaken. And then he did a lot of practice management. And then even though I still have some of the stuff that I bought, how to answer the phone, how to do this, how to do that. So it's interesting. But Chris and John, brothers, they've been working with him for a few years, learn all the stuff from him, and they branch out, and then become rich and famous. So and in different places, they basically like helping a big company to get bigger, and helping company to get the equity and, expand the role on about, organic share. And then, there's a special sequence of event that happens. I would say, when you hit the third dimension, then you have to think about the fourth and the fifth dimension. So that's what they do. And then I'm very fortunate to work with them a little bit in the past. And, I know there's other players in the space, but they're one of the best. So without further ado, maybe Chris, you can do a little bit, intro about, how you see things coming your way, and John as well.
Well, I'd be happy to. And let me first say thank you so much, Dr. Harold and Dr. Allison, for working with us, getting to know us over this last year. It's been a true pleasure to watch all the things that you all have accomplished as a group, as a doctor network here, and to hear your vision for what things could be like in the future. It's really exciting. It's really compelling, and I find myself very intrigued by what is going on in the dental industry today. I'll tell you a little bit about myself personally, and then my brother and business partner will tell you a little bit about himself personally, and then we'll tell you a little bit about our firm as an organization and what we do and how we support entrepreneur dentists. And then we want to give you all a little information about what we see in the market, how dentists are achieving premium values today, what alternative models exist, how you can still make the big bucks without having to sell out to a DSO, and if there's other ways that you can accomplish this. And so, without getting too much more into that, let me see if I can activate the presentation here and just tell you a moment here about myself. I'm one of the co-founders of a company called Align Dental. We formed this organization back in 2016. Dr. Harold was absolutely right. I did spend some early formative years learning with Dr. Roger Levin. I was his director of consulting. I got to manage a team of consultants and kind of meet and greet and work with and solve problems for hundreds of entrepreneur dentists all over North America. And I did that for a number of years. Before I did that, I was actually a management consultant at Deloitte and IBM, doing big Fortune 50 merger and acquisition projects and looking at companies from the outside in. And so I got a phone call from Dr. Roger Levin a few years into my career, and he said, "Hey, I'm looking to take my consulting practice and really institutionalize this, make this better, bring some real world consulting principles to it." And I jumped in and did that with him, and worked alongside Roger, and he's still a friend and colleague today. And in my years working at the Levin Group, we started to get phone calls from dentists and private equity firms and family offices that were trying to grow their businesses. And it wasn't just solo practices anymore. It was the entrepreneur type, the investor type. They're looking to build what are known as DSOs, dental support organizations. And one day we left the Levin Group to start a DSO of our own. And after successfully accomplishing that, in 2016, we started this company, Align Dental. I'm going to pause and let John tell you for a minute about himself and his career, and then we'll kind of tie it all together with how what we do might apply to you all this evening. John, why don't you share some words?
Yeah, thanks, Chris. And really excited to be with all of you guys this evening. We kind of got to watch what you guys have built with this network over the last year and kind of strategizing on some options and opportunities that may exist for this group. Just a little bit of background on myself as well. My entire professional career, I've been involved in the business side of dentistry. As Dr. Harold mentioned, I was at Levin Group for quite some time early in my career. And that was predominantly a practice management consulting firm that worked with dentists on implementing better operational systems within their practices. While I was there, I kind of ran the sales side of the house, and we would look at offices and say what needed to be improved or enhanced to grow the practice. So I'm really good at looking at an office and their P&Ls and their practice management statistics and identifying growth opportunities within that office. And I think I probably worked with 2,500 to maybe even 3,000 dental practices during my tenure at that firm. And as Chris mentioned, we actually left and worked with the family office and started a group practice based in New York. And in the first year, we acquired 13 practices. We built a very large surgical center that was kind of located centrally to those offices so we could capture most of the specialty referrals. And we also did a lot of sleep apnea with medical billing. And then in 2016, we formed Aligned Dental as a consulting firm to work with group practices and emerging DSOs. And so we have a very big multitude of different types of clients that we support and engagements that we cover. Pause there because I know Chris maybe will talk a little bit about, Aligned in itself and some of the initiatives that we implement. But personally, I'm highly involved in the M&A, so the merger and acquisition side of our clients and the firm. And so when dentists want to build platforms to acquire offices, or they themselves would like to set up for a transaction to eventually be able to sell and get the highest valuation, that's really where I typically get highly involved within our firm. So excited to share with you some of our perspective this evening.
Yeah, thanks, John. And so just another moment or two on Aligned Dental before we kind of dig into the industry, some statistics, and a bit of a state of the union on the dental industry itself. Aligned Dental is really good at three things: strategy consulting, operational consulting, and clinical consulting. In our strategy consulting sector, we help dental companies either become a DSO themselves, either maybe raise capital to support their operations, or facilitate some level of merger and acquisition activity to help them become a larger dental group. Within our operations division, we help practices improve their EBITDA, grow their revenue, and lower their cost of goods sold through synergies. And in our clinical consulting division, we have some dentists and lead hygienists that help work with other clinicians to be the best versions of themselves, to ultimately drive higher clinical outcomes and higher revenue, more so within the operatory. And so we have an extensive team at Align Dental. We're a company of 53 employees, and we support practices in just about every state within our country. And we have enjoyed a really interesting reputation through the years that we've done this. We're now known as the organization to go to when dentist entrepreneurs are seeking to do something a little different, when they want to either build their own DSO or do something that's not the traditional route of selling to a dentist or selling to a private equity firm or selling to an existing DSO. What we're known for is taking unique groups of doctors that are like-minded, entrepreneur-focused, that want to work together and create something bigger. And so over the years, we've created no less than 20 DSOs from scratch that started on a phone call just like tonight, with doctors that have come together and shared their vision and philosophy, are already top clinicians in their respective regards, but are possibly intrigued by maybe becoming part of a process and forming a new organization. And we're going to tell you a little bit now about the industry and why that could be attractive to you all if that's a direction that you're looking to learn more about.
I think, Chris, you're a little bit, modest. I think you guys are part of the organization that run the AAP. I remember I went last year. You probably didn't remember me, but I was there last year. You guys run the group practice in Vegas. You guys are the main person who run it. Actually, me and Dr. John went there. We each had to pay $500 just to get in the first day. Okay. Just to hang out with you. Okay. And you guys talk, and, give some, and you're being a little modest, but you guys organize a whole a convention and make plans. You have all these players like Denticon and all these players there, how to work together and make things bigger. But the key thing I think is important is how to get the growth that most people don't see. That's really where the exponential growth is. And also a lot of doctors, a lot of people, they don't sometimes may not see it, they may not understand it. The only thing that I can say is, I'm very fortunate to treat a couple of the vice president for Uber and all these companies that are big, and they make a lot of money even though the company is not really making a lot of money. Okay, so that's the truth. So maybe without further ado, maybe you can teach us a little bit about how we can go to the next level.
I'd be delighted to, and thank you for the kind words, as always. And you're not wrong. We do get invited quite frequently to speak on the conference circuit. And we love doing that, and it's fun. We're kind of the property brothers of dentistry. So John and I kind of tag team that um, and talk through all the different growth models. And you're right, the AADGP has been a fantastic partner resource for us, and we get to headline on the front end of that usually each year with a whole workshop and a unique approach. And we like to speak at all the conferences that'll have us to come in and share our unique perspective. And so thanks for recognizing that. And it's always fun to be with you. Just on that topic here, there's a reason, I think, why so many entrepreneur dentists find themselves in this category where they're joining a network of like-minded colleagues that are going to the conferences to learn more. It's because there's a pretty tremendous rise of group dentists that exists in the country. If you go back to the year 2000 and you surveyed all the dentists, all 190,000 of them in the US, there was actually only about 2% of them that were part of a private, DSO or large group practice. And over the years, the survey results showed that we work with Henry Schein and other organizations on to pool our data to indicate where the trend line has gone. So if in 2000 there were 2% of dentists that were part of a group, in 2005 that number had almost doubled or more than doubled to 5%. In 2010 that number had doubled again to 10%. And in 2015 you'll see to where it went in 2020. By about the time of pre-COVID there, we were at 1 out of 5 dentists that were part of a large group practice or existing DSO. Where the numbers are today, we're somewhere between 33 and 35% as far as the number of dentists in the US that participate with a large group. We believe those numbers actually are a little bit underreported because oftentimes dentists and companies out there do such a great job of letting their colleagues that are maybe associates not even realize that they're part of a large group practice or a DSO. They keep the culture in place where they may not even know how to respond to the survey that they're part of a DSO or large group practice. They don't even realize it. And for those reasons and several others, we think that the numbers could even be underreported, could be even higher than 35% today. But what it tells you is that it's gone up drastically. We're about 2/3 the way up the bell curve. If you follow what happened with the medical industry as a whole, dentistry is about 10 to 12 years behind that. And, all the chips kind of fell when the medical industry reached 55 or 60%. And after that, today that you're probably not going to go to your medical doctor that's not already part of a major hospital network or working, with or for one of the major insurance organizations that operates, major networks today. And so dentistry's headed in that way, whether you like it or not. And we've embraced that and made that really our career, is help doctors figure out where that is, how to take advantage of that, how to get in front of that, and really how to position themselves to kind of create their own DSO. And we'll explain why that might be important in terms of economics and valuations. And I think that's what the next slide talks about a little bit. John?
One last thought I'll add to this slide. When you looked at the early 2000s, the connotation of DSOs was very negative in the marketplace as corporate dentistry and non-dentists telling clinicians how to practice. But at this point in 2025, the train has left the station. DSOs are here to stay, and everyone would be naive not to identify that as kind of the future of dentistry and say, hey, how do we actually compete in this marketplace? And there's a whole host of reasons, and we could probably lecture just on this slide alone and talk a little bit about why DSOs are more attractive for dentists, about debt coming out of school and all kinds of different trends within dentistry. But we really just want to highlight that such a significant number of doctors are really part of a group today, and we anticipate that continue to grow very rapidly.
Yeah. And so a few of the challenges that practices have faced on their own over the past number of years, if you are a private practice, if you're a group practice, or if you're a large DSO, is some of the pretty ridiculous interest rates that you may have seen. If you went to buy a practice or you went to remortgage your house, you saw that interest rates were pretty uncomfortably high. Cost of capital has been extreme. And so a lot of large group practices and DSOs have struggled with acquiring offices on their own today because of that cost of capital. If you were a DSO, and by that I'm referring to Heartland, Aspen, North American Dental Group, MB2, Smile Brands, Smile Docs, Pacific Dental. The list goes on with several dozen. In the most recent years, and throughout 2024 and 2023, you struggled a lot with the cost of capital, and they found themselves in hot water, and their bank covenants became really unmanageable. And so a lot of the DSOs today have been built with financial engineering. They're leveraging and buying too much, and it's costing them too much to service their debt. The same principle occurs for solo dentists that are, buying their own second practice, third, fourth, fifth. They're mounting up with a lot of really, really expensive debt. It leaves dentists with not a ton of options when you have a really hefty balance sheet if you're trying to create equity in your business. We're going to show you in a minute about just some of the equity transactions that occur if you can get past this huge debt burden and deal with what's happening with some of the interest rates in the market. There's good news. We think there's a little bit of tailwind here behind us as we've seen interest rates heading in a better direction. But John, what would you say about the debt markets at this moment?
Yeah. So a lot of this follows the same things you'd be seeing outside of dentistry when you borrow money. If you get a mortgage, finance a car, anything else, we're seeing higher rates. So when you're borrowing money to go acquire a dental practice, and really this pertains to investors or DSOs that are growing, the cost of capital has had an impact to the success of their DSOs. And so really what we're going to talk about the second half of this meeting is how we can use this as a strength for ourselves right now, is to say, hey, we have an enormous amount of equity in the practices today, and we can be more competitive than a lot of DSOs that are struggling with the current debt market. So we're going to teach you how to use and leverage the equity in your dental practices to scale, and something that we'll be able to show you how to monetize over a period of time. And so really just want to highlight and have you guys be aware of what's happening in the debt market. We see, hey, our rates improving modestly, will there be two adjustments between now and the end of the year, to be kind of in this current state for the next period of time.
Yeah, and just one more point on that. If you're a dentist entrepreneur today and you happen to either have your own capital or are seeking to raise some capital to go start your own large group practice or DSO, there's a good chance you're going to struggle and you're going to reach a point where the banks tap out and aren't willing to provide additional funding and loans. There are other ways to go build a large group practice or DSO without having to go to the bank, without having to raise a bunch of capital, without having to spend a whole bunch of money. There's a way, and we're going to get into more details of that in a second, to go build your own DSO really without spending barely any money at all.
Really the power of the group, and that's going to be the consistent message that we want to cover. This slide, I'm happy to cover this, Chris. We don't need to spend an enormous amount of time. What we typically do is map industry transactions to take a look at what multiples DSOs are achieving. And really the reason we like to put this up here is because everyone always asks, if we go build something successful, what can we anticipate will happen at a future recap event? And you can see, about 20 plus transactions here, on the low end and the kind of the eights. And some of those platforms have Medicaid in them. They're smaller transaction sizes, with some transactions pushing north of 13 times. And so there are very, very impactful multiples. And it means that there is still a lot of money in this space, and there's a lot of value for a strong platform. And so we just map a lot of what's happening as businesses recap and study what was successful in that model and why did investors really like that and how did that drive valuation.
Yeah. And just to further on that for just a second, what does it take to be able to go and achieve a premium? How can we take one practice or a group of practices and make this interesting to a private equity investor? We're going to show you the next slide what different individual practices, groups of practices, and DSOs might actually value for on a more tangible level. But what is an investor looking for, and how do you go get this median 10.4 times that's highlighted on the slide here are some of these 12, 13, 14 times EBITDA transactions, which have occurred recently. It takes a few different things to get private equity to get interested. We need a differentiated model, something that's not the exact same DSO that they've seen out there, like Heartland, that's just gone out and bought retiring doctors' practices and also does de novos. They'd like to see something a little different that hasn't already been done and put in front of them every single day, like the 100 other deals that they look at once a month. They'd like to see what we call a track record of organic growth. Organic growth is the growth that you get on your practice without having to go buy it, without having to buy a second or third location. They like to see that one practice and one owner or multiple owners and multiple practices have the ability to grow the revenue within those four walls, to get doctors to do more, hygienists to produce more, and they track those trends. Also important is industry-leading margins. A dental company that just has 10% profitability may not be that attractive. An industry-leading margin is usually a general GP practice that has 27% EBITDA or greater. That's usually the top end of the range, and some can go beyond that. But if you've gone above 20%, and if you are approaching 27%, you'd really be considered a industry-leading, margin there, and that becomes extremely attractive to an investor. An investor also wants a clear path to exit, meaning that they know how to go and take this business that you've built and can get themselves out. An investor doesn't just buy a business to hold it in the DSO industry. They buy a business to grow it and then sell it again. That's how private equity makes money when they work in the dental industry. They're buying businesses to hold them for 3 to 5 years, grow them 3+ times the size of where they bought them, and then sell it again. And they need to see a path to get there. Some of the other cool things to have that might be required to get to a premium would be a group of practices probably needs a built management team or executive team, a team of leaders like Dr. Harold and Dr. Hahn and a bunch of others that understand the entrepreneur mindset of a dentist and can help communicate with their partners and colleagues and can help lead a team. They love to see that you have existing private equity experience already at the table. Investors like to invest with people that have already taken other people's money and done really well with it and can demonstrate that a return can be yielded for them as well. They want to see a pipeline. That means that there's other practices behind the group that are willing to sell, merge, or partner with that existing DSO. And they also want to see that most of the doctors in the platform are owners too. That if there's associates in the business, that they're going to stay on and be incentivized to stay with your practice. These are just a couple of the things that help warrant premium valuations out there today and might attract a private equity investor, a family office fund, or some other institutional type investor. John, would you speak a little bit to the valuations that we see and how they change over time as infrastructure is added?
There's a lot of data on this table, and this is just kind of market ranges. There's always transactions that happen above and below what's listed here, but I think it gives you guys some great context and color to what practices and groups are selling for. So when you have a solo practice, depending on the size and the profitability, we're seeing transactions on the low end of 50 to 75% of revenue for the last 12 months. For larger general single location practices, 4 to 5.5 times EBITDA. Doesn't mean someone hasn't gotten a little bit more, a little bit less, but that's going to be pretty typical. On average, we would anticipate that EBITDA is going to be roughly around 20% or a little greater for general practice. Now you can optimize them further, and some of you may have higher EBITDA practices, but what you'll see is that not many practices are selling for more than 100% of revenue, unless they're signing a very long employment agreement with a DSO. When you start to build a group, The definition of a group is going to be multiple locations, multiple providers. Technically, you could have one large location with a bunch of providers, and we still may call it a group, but we frequently describe that as multi-site, multi-owner, or multi-provider. And as the amount of revenue and the amount of EBITDA in the group scales, the multiple is going to scale with it. So small groups doing 5 million or less may get 5.5, maybe even 6 times. Groups with 5 to 10 million of revenue, or maybe 1 to 2 million of EBITDA, will range at 5 to 7x. And then groups that have $10 million of EBITDA or greater transact on average of 6 to 9 times. Now, it's kind of expected that a group does not have any significant amount of infrastructure yet. And sorry for the background noise. We're having such a thunderstorm here. It's probably carried over into my presentation, but hopefully it's not too bad. As you build a DSO platform, what we're describing there is now you have infrastructure to accommodate the practices. So there's going to be some centralized accounting, some HR, some level of integrated operations. And so the multiples start to increase because of the investment in the team. And so we'll see groups on the low end, still maybe 5 to 8x. And larger groups may transact as high as 10x. And then when you talk about fully built platforms, that's when you have the full complete org chart. CEO, CFO, operations, IT, controller, HR, really everything is fully built out across the platform. And we'll describe what that means a little bit further. You'll see transactions from the low end of 8 to 10x, upwards of 14x in the marketplace. Now, there's going to be some variables depending on location, payer mix, and terms that come with the transaction. Obviously, if someone says, hey, there's going to maximum cash at close, a lot of times the multiple is going to be a little bit less. So we could spend a lot of time mapping this grid and different types of deals that take place. But as you migrate from top left and say, hey, small single location, they're typically selling for 50 to 75% of revenue. When you get to the bottom right, we're talking about double-digit multiples. So that same practice that's integrated in a DSO is typically worth 3 to 5 times as much money than the single location. And also, when a practice is part of a DSO, the EBITDA is usually much higher because the DSO has a lot of resources to drive better costs, higher reimbursements from payers, and a multitude of other value-add components across the platform. And so really what we're trying to demonstrate is if you guys successfully can integrate a large group and build out some common management and get on one platform, practices, stand to increase in value not less than 3 to 5 times from their independent value today.
Yeah, really helpful, John. And the way that I understand it, and talking with Dr. Harold and Dr. Allison and team, is that the majority of you all as colleagues and friends probably sit somewhere in the solo category or in the group category existing today, somewhere in one of those buckets. It would be our goal to show you all what it's like and what the path would be to get you down into the bottom right quadrant. How you can take one existing practice that maybe on its own independently is worth 5, 6, or 7 times EBITDA and have it worth 14 times or potentially greater through the right integration, the right amount of systems, the use of technology, reducing cost of goods sold, and integrating onto one large, robust, what we call investment grade platform. There's no reason why, if I'm an entrepreneur dentist out there, that I should think that my only path is to go sell to a DSO for one of the numbers that are listed in your quadrant, wherever you are, wherever your practice fits, based on the revenue and profitability. Why you have to stay in that quadrant. And we're here to show you how we can move all the way to the right and the bottom right specifically. We've done that no less than 20 times with different groups that started, like I said, on a phone call like this. Doctors coming together. Now, one practice in and of itself isn't going to be able to jump the line and go to that DSO platform light or all the way to the full platform. It takes a group. It takes a collection of doctors that all have a like mind, are entrepreneurs, and want to be part of something bigger. There's a lot of, discussions out there in the industry. Hey, should I sell to a DSO? What is the good, the bad, and the ugly of that? And we oftentimes say, why not build your own DSO? why not pair up, become partners, and you guys and gals dictate the rules? There's no reason, why you have to subscribe to some other DSO's model just to participate in some of the upside. Why not define the rules yourselves and say, hey, this is how we want to form and build our own DSO. This is what I want my employment agreement to look like. This is the way that I think we should share equity with each other. This is how I want to go to market and when I go to market. We lecture all the time about this. Why don't you build or become your own DSO as opposed to selling to one and losing all your control and autonomy and the majority of the upside economics? What does it take to get there? It doesn't just happen overnight. It takes a process to take individual practices that may be somewhere on this spectrum in what we call the mom and pop red area of the 10 functional areas required to become a DSO to getting all the way into the green zone. The green zone is some level of investment grade. The green zone talks about a proper legal structure, that practices have contributed their equity into one parent company, that allow for a consolidated cap table, as it's known. Right now, the term cap table probably doesn't mean a lot to entrepreneur dentists that haven't been part of a process. Your cap table probably is just a chart of one, meaning you own 100% of your business. A cap table, or the capitalization table, is in a DSO is made up of many parties. It might have an investor. It might have 10 dentist owners. It might have 100 dentist owners. But basically, it's the tabulation of all the owners of the business, portrayed in a very simple and effective manner that attorneys can read, and is really listed in the last page of one's operating agreement. But a DSO legal structure looks a lot different than that of a practice. To get in the legal area over to the investment grade, we actually have to change that around. And then, a private equity firm, they're not owned by dentists. They're owned by business folks. And so in order for them to be able to participate in the economics, we have to change things around. We have to move the equity and the value of a dental practice into a management company or into a DSO, a dental support organization. That's all that is. It's a fancy legal term for allowing non-dentists and others to participate in the economics of a dental business. And so the legal structure is simply just a matter of migrating the value and the equity of a practice over to a company that would be just more of a simple limited liability corporation and not a professional corp, which most dentists structure their business as. And we do this on a large scale, and it creates a structure that becomes investment grade. I can go on for, all 10 of these areas, but I don't think we have all night together, but I can just highlight a few. Right now, you all have some semblance of accounting done in your practice. Some of you may have what we call shoebox accounting, where you bring all the receipts, go to your CPA at the end of the year and say, well, here's my receipts for the year. Can you prepare a tax return? That's not very sophisticated accounting. Others may have more of a quarterly financial statement prepared by either a bookkeeper or a CPA. And all the way over in the far investment grade category are going to be monthly financial statements prepared on GAAP formatting. It's known as generally accepted accounting principles. It's more of the accrual method, and it's a more complicated and sophisticated accounting system that banks and investors like and understand. We would report the same way that Fortune 50 and publicly traded companies report on, which is a certain language that banks and investor types appreciate. The last and third most critical part of a DSO is the human resources structure. Right now, I would guarantee that if there are 37 members and team on this call, you all have a different benefits package. Some may provide benefits altogether, some may provide none. Some may offer 14 days of PTO, some may offer 40. Some, may contribute to a 401k, others may not. But when you're a DSO, it needs to look exactly the same. We've got to treat all the employees in the same manner, and we can't discriminate in any way. We can't offer one employee a health insurance benefit and not the other. And we need everybody on one common payroll system. and a few other things that are really critical to managing teams and employees. And then the list kind of goes on for some of the other more behind the scenes functions in a practice, like procurement, marketing, rev cycle, all the things that start to add value. When we get those more into the green zone, we can become an investment grade DSO. And we're going to start to warrant the 10, 11, 12, 13, 14 plus multiples of EBITDA that most entrepreneur dentists are seeking. Just a little bit about what we call a chart of accounts, the accounting exercise that hopefully you all are getting from your accountants on a monthly basis, but not always the case. In a perfect world, the dental practice numbers would look something along these lines here. Total dentist compensation would be somewhere around 21% of the practice's revenue. The staff comp, if you're a general practice, would be at 21 as well. That should be comprised of 7% for hygienists, 7% for dental assistants, and 7% for the management or administration of that practice. Benefits and all the other numbers kind of follow suit from here. But ultimately, if we're going to go create a DSO and we're going to bring colleagues and friends in together, we need to get everybody's practice on one chart of accounts. We need their accounting system to look and feel and act pretty much the same way. We don't all have to go switch CPAs, but we need to submit financial data so that we can portray everybody's financial statements in one clean manner, and we all are calling things the same. We all call our dental supplies the same exact and code them the same way. We pay ourselves the same. Some practices I know just take distributions if I'm the owner and I don't actually write myself a salary. We just need to normalize some of those things to get everybody's accounting looking the same. And in a perfect world, this, for example, $1 million practice would have 24% clinical EBITDA, which means the net profit after paying a whole the bill and paying a normalized salary to the owner dentist. John, what am I missing on chart of accounts here?
Not missing a whole lot here. What we're trying to show you guys is the accounting playbook on how you make practices kind of apples to apples across the board. And you say we need to pay ourselves as if we were employees in our own offices and kind of rebuild the P&Ls, not to minimize taxes, but more to say, hey, how's this business actually performing? We're not actually implying a tax strategy where we're saying, hey, go start reporting a ton more income. However, what we want to go do is organize the P&Ls and identify what is the performance and be in a position to tell that story at some point in time, so that you guys can command maximum value at a recap event.
Yeah. The
Can I
biggest
ask a
part,
question for the
Yeah.
previous slide?
please do.
The for that 1 million practice, and you're paying the dentist at 21%, and current market, we can't find associate doctor pays less than 30%. It's gonna range from 30 to probably 40%, more likely.
I would agree. And it's was that Dr. Amanda that said
Yeah.
that?
Mm-hmm.
Well, it's a pleasure to meet you, and you're absolutely right. We can't go pay doctors 21%. However, as a percent of revenue, the doctor's salary should equate to 21%. Let me show you how we get there. Would you agree that a typical one doctor practice should have, let's say, 2 hygienists working to support the practice's patient flow?
That will be very nice.
It would be ideal. Not always the case. But let's say in this hypothetical example, we have 1 doctor and 2 hygienists. In a typical GP practice, we like to see 70% of the revenue coming from a dentist, 30% coming from a hygienist.
I
And
see.
it could be much greater. So in this example, this doctor that did 70% of the revenue of the $1 million practice would have been paid 30% of the $700,000 that they would have generated. Comes out to $210,000, 21% of revenue. And that model will flow and fluctuate if it was a $2 million practice, $3 million, or a $100 million company. The doctor comp.
It's just that the doctor's only paid on the doctor portion of the revenue, and we're estimating, for an example, that 70% is being done by the doctor, 30% is being done by the hygienist. So 30% 70% is 21%, and that becomes the target.
And
Does that
so
all make sense?
Thank you. Thank you.
certainly.
Of course.
And these are some of the ratios that if we've not normalized the doctor pay, if maybe you're a dentist owner that just takes draws and takes the whatever's in the checking account at the end of the month or the end of the year to pay yourself, we need to do a little bit of normalization with the books. We want to see what is the actual rate it costs you to pay your doctors. If it's greater than 21% of revenue, it tells us, okay, this could be a higher, lower margin practice potentially, or we have an opportunity to improve some things, but it's an indicator. These are just general targets that we want to be shooting for. And we put everybody's practices into this profile to see where we're out of whack, where we're
And lastly, we see
overpaying. Yeah.
some practices where hygiene accounts for 40 or 45% of the revenue, which means the doctor compensation percentage should be much lower. Alternatively, we see practices where the doctor's doing the hygiene, either because they can't find a hygienist or the cost model doesn't make sense or they're not busy enough. So this example would just show that at that 70-30 kind of traditional breakdown. And I feel like if we went around the room and just, pulled hands, probably in that general range across the company.
That's right.
That brought another question that I was thinking about, which is a little off the topic that you guys are talking about right now. I had a conversation with PE, somebody who is actually interested in investing DSOs, and he mentioned to me, I mentioned about our group, and he mentioned to me that a typical DSO will have no interest in if you group a bunch of mom and pop shops that have revenue under $1 million. And they're not even interested if it's between 1 to 1.5. They have less interest in those groups. And definitely not interested in somebody who's, if you whole bunch of practices, that's the lower end, producing less than 1 million. DSOs or private equity have no interest in purchasing that DSO.
So that's one perspective. I don't think that speaks to the entire market. Maybe that investor's philosophy. Some buyers love the idea of practices that are not performing at the highest level that they can go enhance. What needs to happen is the infrastructure across the entire group to say, hey, that these practices are integrated and we can add value to take a practice. Because if you can show a path that you can take a practice when it joins your group that's doing less than $1 million and you grow and improve them, it's a fantastic track record and actually commands a higher valuation because they can buy cheaper or more distressed assets and improve them within the business. And alternatively, if you guys were all $2 million practices or greater, it's actually a challenge because now we have something called key man risk, because I don't believe you can go find a whole bunch of new associates that in the first year or two can produce 1.5 or 2 million. So I think there's a little bit of a range in philosophy. I mean, people like cash flow and they like bigger operations because they're stable and they like what they step into. I think we have a little bit of a different perspective along the way.
Yeah, I think though what Dr. Amanda is saying though holds many truths. That if they are a private equity backed DSO, they have a certain buying box, as it's known, and they would prefer to go invest in practices that are greater than $1.5 million or $2 million because it's easy for them to see a path to getting more EBITDA. They have to do fewer deals if they're buying and investing in a practice that has more revenue and more EBITDA. And it's a lot easier to take a $1.5 million practice and grow its revenue by $500,000 than it is necessarily for them to take a $500,000 practice and completely revolutionize this and grow that, far greater than where that is. And so it just kind of is a perspective of who is the buyer. And if you reference it's a private equity firm, private equity firms really won't get into transactions that have anything less than 3 million of EBITDA, net profit, and really are seeking to invest in companies with 10 million of EBITDA or more. And so I think there's truths on both sides, there's not one right or wrong way to look at that necessarily. So one of the, please, if there's other questions, we'd be delighted to pause and answer. If not, we'll just jump right in. And John, I know you oftentimes like to cover this one related to, that doctor pay normalization. And I heard earlier you say, hey, we can't quite, pay a GP 21%. No, we have to normalize and have our partner doctors in one of these ranges for
Yeah.
whatever
So there's
specialty you're
always
in.
an exercise. Yeah, there's an exercise to figure out how to calculate your EBITDA. And first, we have to pay each of the doctors, even if you're an owner, if you see patients, we have to pay you as if you're an employee in your practice. The EBITDA is the additional income you make after we've paid you as if you were an associate yourself. And it's the sum of the income and the benefits. And so, how we pay you and the comp model of the group is important in figuring out how much money gets allocated to the provider work and then how much money flows through because you own the business. In general dentistry, it's pretty straightforward. On the low end, you'll see DSOs paying 25%. Heartland is known to be able to pay a little bit less. And you'll see DSOs sometimes paying upwards of 33%. There are some that pay a little bit higher, 35 to 40%. It's pockets around the country. I see a lot of stuff in Delaware and New England where doctors won't work for less than 35%. But DSOs really like to stay in this range, with 30 being most typical. A lot of times the company will pay the lab bill as long as the dentist uses a company negotiated lab that the doctors pick. It's a whole other conversation about clinical governance and all of that. But, really normally we would use about 30% as the target for general dentists. Ortho is a little more complex. Sometimes we'll have a daily rate for the doctor with a bonus for starts. We might have it based on collections. Typically, it's going to be a lower percentage than general dentistry because the case is done over roughly 2 years. So you wouldn't want to pay a ton of money out on the front end when it takes 2 years to go do the case or the quote unquote work in progress. Or you'll see flat salaries for orthodontists. And so perio, we'll see a little higher, 30 to 35%. Oral surgery, 40 is fairly typical. A lot of times you'll see they'll pay the oral surgeon $300,000, $400,000, and then they'll get, 40% after the million, for every dollar above $1 million. So they kind of get a guaranteed base salary for coming in. Endo, we'll see 35 to 40%, sometimes higher. And so we're talking more about how a DSO treats it than necessarily what you guys have to pay for an associate yourselves, like how we want you guys to potentially think about structuring it. Pedo oftentimes is 35%, a little higher than general dentistry because more of the work and the fees are being billed out to the assistant or the hygienist, or kind of the house, if you will. And then implants, like full arch cases and more complex practices, will sometimes have some modified things where they may pay a flat fee for an arch. And because the cost model is different, the lab bill or the supplies, the implants are high. There's patient finance fees and marketing expense and other things that kind of move the needle outside of the norm. And so we would always have a discussion about that. So here it gives you some industry guidance on what's traditional. This is not the rule, but this is going to be the norm.
Yeah. So, if we were to leave here tonight and 5, 10 of you all were to say, hey, let's go become a group. Let's form our own DSO. I really like what Dr. Harold and Dr. Hahn have thought about and, wanted to put together here. This sounds interesting. One of the first things we talk about is, hey, we need to normalize the owner's pay. And we have to, if we brought together a group of, specialists, whatever you are, as a dentist, we got to figure out what the right way to normalize it to determine how much EBITDA each practice actually has. And how are we going to pay ourselves for the foreseeable future? And what's the fair way to do it so that we're still delivering the right EBITDA that we underwrote in the beginning of this process? So the first question would be, what do y'all want to pay yourself? And there's an implication to that. I'm sure everybody would like to have the highest wage possible, but in turn, it lowers your EBITDA. And there's a sweet spot that still allows for the best and maximum owner pay, but still yields a high margin to demonstrate that, hey, this company is investment grade. We have those high margins that private equity likes to see. We've got to find the sweet spot. And if we're putting together a periodontal DSO, a surgery DSO, an endo DSO, pediatric, ortho, we've done every single specialty and we work with all specialties across the board with the DSOs that we form. We got to nail down the right sweet spot. And it's one of the most important dialogues that we'll have with a group when they come together.
One last point. We can't make Dr. Comp look really low just to create EBITDA, because if a buyer steps into this and we say we pay ourselves 15% as general dentists, but then it makes the EBITDA look really, really high, they know that you guys can't go hire a general dentist to work for you at 15%, and it's not a sustainable model. So really the governance or the guidance that we provide is to say we need to put it within the middle of the fairway of what does it take to hire a doctor if we wanted to replace you in your practices. And that's going to be the driving force of how we set these valuations, as well as looking at what is an investor going to want to step into at some point when you monetize the company.
That's right. And so let's say we have understood what everybody's EBITDA was that was looking to participate in this group. Now we've got to work towards and create what's called that cap table, the capitalization table. And this is just a sample one of, a very small sample of, let's say, 3 different companies that were coming together that had the revenues that are notated there in that first column. And we had gone through a process, usually to design the legal structure and design the accounting structure and the HR structure, and to run everybody through a process to determine and glean the EBITDAs. Everything boils down to a number at the end of the day. We got to determine what's the value of all the practices that have come together, and what's the net equity that they bring into this business. Do any of the practices that are coming forward have debt? If so, we're going to need to provide a calculation for that. So let's say 3 doctors came together. Each of them had $1 million revenue practices. One had $200,000 of EBITDA. One had 300,000 and one had 400,000. And we agreed, okay, they're all going to come in at 6 times their EBITDA. The one that had $200,000 of EBITDA is worth 1.2 million. The one that had 300,000 is worth 1.8 million, and the one that had 400,000 is worth 2.4 million. We then need to put together the sum of the parts and determine what's the total value for this organization. Now, any of those 3 practices might have had debt. If we're going to go create a new company together, we're going to need to refinance that debt into one new loan that the new DSO is going to be the guarantor on that debt. So we need to create a net equity. So let's say that first practice with $200,000 of EBITDA that's worth 1.2 million had 0 debt. And the practice that had $300,000 that's worth $1.8 million has $200,000 worth of debt. Well, that 1.8 million value practice post its debt of 200,000 is actually only worth $1.6 million. And you can see how that might get extrapolated amongst a whole group of partners. We have to build this complicated capitalization table to demonstrate what's the net equity of all the companies that are coming in, and what's the fair way to treat all the debt, and how are we going to go get that refinanced. We work with groups like you all and spend the better part of 9 to 12 months together building a DSO, and ultimately the final product is a legal structure, an accounting platform, an HR platform, and a cap table that shows how much of this new company everybody owns. And
Chris is saying here, just to clarify, is if 3 practices come together, they're not always traditionally 1/3, 1/3, 1/3 owner. So there's the valuation of each of the practices based on their EBITDA. And then also how much net equity do they have if they have debt on their practices. And so there's a large scale accounting exercise to evaluate each of the practices on their own, and then kind of compare them apples to apples and what they look like in a combination.
that's right. And so we don't, we could spend a large amount of time talking about cap tables and what the implications of, putting together an exercise like that is. But I'd rather pause and see, Dr. Harold, what questions might we have elicited from your colleagues here about a process, about what it's like to try to go create your own DSO today, as opposed to selling to one out there in the market and losing autonomy, control, and all the upside economics?
I think I'm sure a lot of people have some question. I'm pretty sure they're going to ask you. But personally, I think what I see is the fact that the difference is like when we all first started, and that's just my humble opinion. When we first all started become a dentist, we all started work for somebody else first, and then we take whatever they give us, and then we do whatever we could. But then when we get better, we start our own office and we do our own thing. Most of the people go through this exercise. It's a little bit difficult, but in the end, your long term is better. It's not going to be a guaranteed sweet spot, or it's not going to be, you're going to have your cake and eat it tomorrow. But it's long term wise, if you stick with your vision, your opportunity is always going to be much better than just you work for somebody else. Today, this is a consolidation world. Everybody consolidate, and then I have, for some reason, I'm very lucky. I have 2 or 3 people from stage coming to work for me, and I have other people that have their own practice come work for me. And what I learned is sometimes if you position yourself right, and you're not just a number cruncher, you actually can follow the model, and you can have a very, very good EBITDA if you know how to max out in each area. Because maxing out in each area is the key. With today, with AI, with all the opportunity, you can actually have your whole model set up in AI. And that's very, very easy, now versus back in the day. So we have a lot of advantage. But the good news is in this group, most of the doctors here are Chinese. And one thing that I can say is they're very, very hardworking and very strong. They're almost like super GP. They do things that most other GP don't do. So in that part, and then we usually save a lot of money, traditionally. So our equity is usually very, very strong. Also, that's something that I think one of the biggest advantage that we have. Obviously, our goal is to learn from you guys, to learn the best strategy, copy what the best system is, and then make it even better. And that's really something that we would like to do. And, Chris has already given us some of the area of, that we need to focus on, some of the area that we do. But ultimately, if we want to really expand and go to the next level, I think this is the only way you can set your own rules and you can do your own, protocols and things like that. And I think that's something that, most people would love to have if they're given the opportunity.
Really well said, Dr. Harold. I think you're spot on by that, and that's why this is a different model. This is what's unique, but this is actually what has become more prevalent today in the last, I'd say, 2 years than ever before. It's kind of this second wave of entrepreneur dentists that have been quietly building something on their own, watching what some of the rest of the industry is doing, taking the good and the bad, right? Watching what has worked in some, avoiding what has not worked for others, and trying to build their own. And there's still plenty of runway here where investors are seeking to deploy capital in doctor-founded, doctor-owned, doctor-led DSOs, not necessarily the ones that were just founded by 1 or 2 individuals that bought up everybody. They love the fact that there's still models out there where dentists retain a significant amount of the equity because it implies longevity, and everybody is going to think like an owner because they are one.
And so one of the things we look at when we start these projects is to try to identify what are the raw ingredients to do something better or different. And that's what becomes really attractive when you go try to monetize the business. And Dr. Harrod, what you said is to say we've got this network of doctors that have a similar work ethic and kind of elevated clinical philosophy and clinical ability, and that is the raw ingredient of what's significantly different. And so if you were 10 dentists, or in this case, tonight we have 35 participants on, 35 people that never met each other, that had very different models for how they practice, and it was extremely disparate in nature. that's not value. That's saying, hey, we have to try to solve the creativity or kind of, the build the raw ingredients through structure and through complex ways to pay you guys differently and try to be, attractive. You guys are bringing something to the table that's already different, and you have a lot of value in what's been created with the power of the group. And now we're saying if we can help to architect combining it, that's how you guys set yourself up to monetize the power of the group. Today, we probably barely scratched the surface as far as being able to leverage even additional benefits and synergies to each of the practices. You've done the hard work for us, is to kind of actually build this network. That's where we say if we can, identify something that already exists, we can go harvest that. And so we teach you guys how to go, build something that allow you to capitalize on what exists here today. And so, that's what gets us excited when we try to identify the raw ingredients of projects like that. That's what we're seeing here in this, is that you guys have a network, and that's going to be really, really attractive to someone else that comes in, because we can scale really fast and you can come out with a much higher valuation because of what exists.
Absolutely. Well, thank you so much. And I think there's probably, in my group, because, most of them, are very hardworking dentists. Sometimes they very focused in the practice instead of on the practice. So, they probably have a lot of questions, some simple question, how to get around certain thing. And, the way I see it is always going to be a little bit of challenge, just like, what I say earlier, when we, first get our degree, we don't know much about implants and stuff, but, we learn how to do it diligently, learn from other people who is better from us. So, I'm sure they have a lot of questions to, shortcut our learning curve. And that's what we're here to bring you here, to give us the opportunity and also the guidelines, so we can, get a little bit shortcut to get into the back door, and then we can, get a little bit ahead and make the best out of the situation.
Yeah, well said. Well said. And that's the part here I think that's critical. Is kind of trying to shortcut the process, right? How can we take advantage of the momentum that you have, bring your network together? The hard part, as John mentioned, is trying to find and bring a group of doctors together that want to be part of something. That could take years and years and years. You have that over the years that you've developed this, but you have it at the table now. And now it's taking that and accelerating those that say, hey, I'm interested in being partners together, going through a process at least of, becoming a partner, taking the first step in that direction, and going through a series of underwriting and sharing of information, and showing everybody this is what my practice is, and allowing us to put together a model for you to say, hey, this is what the equity would look like. This is what the value could be. And this is what the path to successfully monetizing your business over whatever timeline it is that you think you'd like to monetize it. If you say, hey, let's come together and let's sell this to private equity in a year and a half, I'd say, okay, there's a path to do it. We got to get started right away. Or if you said we want to sell in 3 years or 5 or 10, we would just create the critical path to get there. You've got the raw ingredients in front of you to accomplish one of those timelines. It just depends on what the group wants to do.
Helpful, maybe if I just give you guys a quick overview on what the process actually entails, because I think some people think, hey, it means that tonight you guys are already committing to joining the group, and it's not exactly that. What we try to do is say, hey, when we work with a network like this, it's to say, let's identify doctors that like the concept and want to look at potentially participating in the creation of an actually legally formed group or DSO. And it starts really with an evaluation of each of the individual practices to see on their own what it means for them. And it has to work. And so that's in everyone's interest and in the individual's interest. Everyone else does not want a practice to come in that's not going to be a good fit for the group. And everyone individually needs to know what it means for them economically, and then from decisions and things like that. So we do an apples to apples comparison of each of the practice entities, and it's a pretty significant diligence process. And then at the same time, we facilitate a variety of exercises similar to the ones we put on the screen here tonight. How do we want to pay ourselves? How do we want to make decisions as we grow? How do we identify, the voting thresholds for critical decisions like selling. What happens if someone wants to retire? And so we start to identify the solutions and how do we create something that's very stable and beneficial to everyone, but gives you guys flexibility that you would not have if you just sold independently to a DSO. We kind of write the rules amongst ourselves on how that's going to look. And then along the way, we kind of identify if it makes sense for each of the participants to keep moving forward in the process. And so, that's really how these things come together. The fastest one we've ever done, we can put a group together in 4 to 6 months. We've had groups that intentionally take over a year because they want to do a lot of strategic.
No,
They
they're
want to do a
already
lot of
done.
strategic planning along the way. I'm not sure. There might have been a question there.
I think those are probably just background
Okay,
noise.
no problem. But yeah, but on average, the process is typically somewhere between 9 to 12 months until a financial evaluation's been done. We've designed the legal process that satisfies everybody that's going to be a partner in this. And we've begun the first level of integration to get the practices onto one platform. You heard John talk about the timelines, but most commonly it's done in somewhere between 9 and 12 months.
You want to say something about some of the good opportunity? The process I always mention to some of our partners, or we have quite a few people in the group that we know each other for quite some time as friends, and we always say that when people join together they get a bigger pictures, but the picture would get better. We just talk about how do we grow to a different level. The picture will also talk about the founders pool. So maybe Chris, you can talk a little bit about the founders pool. How we can exponentially grow a little bit with that.
Yeah, absolutely. Those that jump in first to an idea like this and are the early adopters should always get some level of preferential treatment, right? There needs to be some way to reward those that have stepped in first to this model. And there's a variety of ways that can work for the different founders that might come together. Perhaps it's a reserve of some amount of equity in the company that sits there and sits as a priority to those that have come in first. Maybe it's an alternative valuation or a higher multiple per se for those that have come in. Maybe it's a preferred rate of return on one stock that allows those that have chosen to come in first. Because ultimately, once this original group comes in, we're going to want to bring in other practices all over the country to continue to grow this. But we need to be able to make some arbitrage or some spread on the rest of the practices that follow. And that is how we can become what's known as accretive in value as we grow and continue to create more value for the original founding group that comes in. These are all quite commonly done in the industry. Those that are kind of the leaders, the first to step into something that is new and take the risk on their own to work and design and build and spend all the hours. I know you're all extremely hardworking group, and this process would add, additional burden to that and more hours and time and diligence and decision making and meetings, but comes with that some of the rewards for having been the promoters, the early entrepreneurs, and the founders in that. And there's no one right or wrong way to do it. There's no less than 4 or 5 different techniques that could be used. And I'd more put that to the group to say, what we think is fair to those that want to lead and become part of this process. Ultimately, one thing to think about, if you're going to become part of a DSO that you're going to form, there's probably 3 ways that you're going to get paid going forward. Number one, you're going to get paid some semblance, some percentage as a dentist in your own practice, somewhere between 30 to 33%, I would imagine. Number 2 is as an owner of this business, you're going to be entitled to the distributions that the business kicks off after paying debt service and paying management. There's distributions that should be available on a quarterly basis. If 20 dentists come together and they're all equal, maybe they all own 5% of this business. If the business kicks off, 10 million of EBITDA, well, then that means that my 5% should yield to me an additional $500,000. a year in distributions back to me. And then the third way is when we go to capital events and we sell this business. You know, if we go and have a private equity investor buy 40, 50, 60% of this business, whatever that multiple is, I'm going to now get paid in a third way at a capital event. And all three of those ways may continue long into the future. And at subsequent capital events, we would hope that the business has continued to grow. We brought in more colleagues outside of the original founder group, and we've been able to pick up arbitrage on those. And our price now is like a stock. The value of that continues to go up. You've watched probably the crazy meteoric rise of stocks like Amazon, Tesla, cryptocurrencies like Bitcoin, and the way that the early investors in these return significant yields over those that may have gotten in a little later. There's still great returns for those that participate 1 year, 2 years, or 5 years down the road. But the original founder group is always the one that is rewarded the most.
That
Well
brings
said.
a question for Harold, and I think I'm one of the original people that start hearing about this DSO from about 2 years ago in Houston, Texas, when NDPO first formed, and we have been talking about it for years, and I feel like we're still just running around the peripheral and nothing solid in the way of Chris just mentioned there are different ways to structure the DSO. And what is the decision for the DSO? There's nothing in front of us. And Harold keeps talking about join the DSO, join the DSO. What am I joining? What is the rules? What is the blueprint? What is the business plan? Those needs to be laid on the paper in front of us, not just keep talking about it. We can talk about it for another couple years and see nothing happening.
I'll let Dr. Harold answer that first, and then I can tell you the answers to all of those questions if you would like as well.
I think Chris probably have a better answer than I do. I think Allison want to start tomorrow, okay? But me, on the other hand, I would like to help my friend to grow the numbers a little bit better. You know, I have some, I got lucky. I got some system in place. I want to help them to jumpstart the numbers, the EBITDA. I always mention to them that, you know, maybe we won't go all the way to the ceiling, but you know, the minimum we can do is grow our profits. You can easily double or triple your profit if your plans is good. If you get everything organized, even though you're by yourself, worst case scenario, you still double your profit or triple your profit in the end of the day. And then if you really can merge together, then you have a starting EBITDA that is way higher. Okay, that's something that I think would be good for some of us who is maybe a little bit behind. Okay, because most of the doctors, they work as a solo. Okay, they don't have the numbers, they don't have the resources. As I believe, at least for me anyway, my goal is at least, like you say, 45% to 50% of the practice should be paid for from the hygienist. You know, the goal is to get the top level of every single discipline, you know, to max out the number, so you know your profit is better in the end. On the other hand, another better thing to do is we can write the bylaw together instead of I wrote the bylaw for you and tell you how is it going to be like. So one thing is like, you know, we can always go to stage, but then stage is going to have a bylaw that is rigid. They're not going to bend for you. But if you decide to write your own bylaw, you have a say on how you can put it together. So to me, that makes more sense. I'm more of working together instead of just telling people what to do. So that's just the way I am. On the other hand, I think Allison want to like starting tomorrow. And hopefully Allison's not here today because I've been looking around and see her. But Anyway, I mean, I think it's good to give some time for people to beef up the thing. Just like if you want to sell your house, you want to clean up your house, stage your house, and make it look pretty so you can get a better price. I don't know if it makes sense to you. Maybe Chris, you can correct me if I'm wrong.
Yeah, I think we all have probably different philosophies on that. What I would tell you all, and I think that was Dr. Amanda who asked the question. I think it's a great one. I would tell you, if you have a group of like-minded doctors that are ready to go, there probably is no reason to wait longer than beginning the process together. I'd like to do the best of both. What Dr. Harold was talking about is designing the governance together. And that's what we always advocate for. Starting a process for those that are ready to participate and design it while the company is being built. That's how that works. We have the business plan that we've executed on for over 20 other DSOs that we've started through this exact process. And it allows for those to identify if this is right for me. And it still gives folks time to modify and improve as they go through it. And
so the other thing that I think to hit on here that's really important is forming the DSO doesn't mean we're selling today. The job of the DSO is to grow the EBITDA as we come together and after we come together to enhance the practices. And it's easier to help each other once we're more formalized in a group than in more of a removed passive setting. And so I do believe that when you look at the market, like the saturation is happening very fast. Back in 2020, we were only about 20%. Today we're already probably 30 to 35% consolidated. So I do think there's some amount, I want to say urgency, but time sensitivity to go do something if it's in front of us. That said, I think it needs to be planned and thoughtful, that it makes sense and accomplishes the goals of the entire group, and it's different and it adds value, and that it works. And then really what you said, Dr. Harold, is that you want to make sure that you're helping your prospective partners maximize their practices and to get top dollar, but top performance, and just excel at the highest level of what we're doing. I believe that should be done by leveraging the common resources in the platform with the group and the people that participate, and then building kind of a model, whether that be education, or training, or systems and things. We say we come in and we can do these amazing things that grow these practices. It'll actually make other people want to join you faster and make you more scalable. So our philosophy would be, we try to capture a little bit of, the interest and the opportunity, but then also just try to make sure that it's planned and managed.
Totally agree. I think the digitizing process probably will not take more than 3 to 6 months, but the integration would be quicker if you have a good system together. The good thing is most of the people, they know each other. In the past, I usually doesn't like to look too much in the past, because we have other people that was actually putting the system together. So and I never like to say anything about other people. I can only say about the group of people they will work with. And then the group of people to work with is very, very good. Dr. John has always been very helpful in helping all of us and have lead us to form the group. And Allison has been very instrumental and bringing her software and also her education. I think also in next month we have some education together and things like that. So things are coming together. We do want to have the right partnership, and not just every partnership. So that's something that we wanted to pick and choose, with the right philosophy, right, ethnic ideas. We were all Chinese anyways in here, most of them anyway. So, and then we're going to branch out and then, form the right strategic partner, especially with you guys, so you can guide us along the way. And that's the reason why we bring you guys here, to show us what's the right step to do and guide us along the way to make it happen. We're not going to know all the detailed step, how we're going to make the crystal ball, but at least we have the right guidance, and with the right attitude we'll go somewhere. And then but the worst thing is we're still making some profit by integrating, and also we also gain a lot more momentum and a lot more level if we can, put our way, our, other put our strength together. What I'm saying is put our strength together and make it stronger. And that's like something that I would like to do. And it doesn't take just me. And I think it takes everybody else that with the right mindset that we're going to, cook something together. Let's see what we can each do to help the team to make it work.
Also, I think it'd be very powerful to get the group focusing on the strategy of what the DSO should look like, and at the same time potentially you working with the practices on some of the enhancement strategies. And I think you could do both concurrently. People said, hey, I really want to spend some time looking at how this combines. And there's also, I want to say, a coaching or development component happening where you're able to come in and kind of enhance the hygiene model, or they're driving more EBITDA that way and maximize them, and everyone gets credit for that at day one. And so I think there's a lot that could be accomplished. We're just very big advocates of it's so hard to get into where you are today with the size of a network. We want to help you guys turn it into something that is really, really meaningful.
Absolutely. Okay,
Yeah,
so
and just one last comment on something John said. Let's say you all did say, hey, let's go and embark upon this process. And it takes somewhere between 9 to 12 months to underwrite the practices, design the legal, and create the structure that you guys are going to merge into. The longer that you operate then as a group, the more valuable you'll be to private equity at that point. So if we come together and spend 9 to 12 months, we'd be telling you at a minimum, go operate as a company and improve the practices for another year or longer to get further integration, reduce the cost of goods sold, get on the same common vendors and other common systems, maybe even practice management software at that point. And then the value of the group will be that much higher. Jumping right into an investment after merging would not necessarily be advisable. So there's actually already a lot of time built into this process as it is. Just things to think about as you look.
It's hard because if you guys take 9 to 12 months to form a group, the next day it doesn't sell. You guys need to say, hey, we've operated as a company for a period of time to show some track record, and then an investor steps into that partnership. And so I think we also are sensitive to goals and timeframes of everyone, and that's something we would encourage you guys to have an active discussion about.
Yeah, I have a question. If I heard right, you said, is there a qualification process at the beginning? Because each of our practices are so different in the ways of the software we are using. Are we in network? Are we out network? How do we have hygienists or we don't have a hygienist? Our staffs are so much different. But of course, I understand if it's like everybody does the same thing, and how much we, our collection and everything. So it's just a lot of work, to get started. So again, either evaluation process, that means like for this, we've been talking about this DSO for longest, like, at least 2 years, just like Amanda said. I have the same question. I know it's a great idea, to have either better, you can get more profit, but does it really worth, to go through the process, and have to get all the numbers and ready to go through this process, and how much it's gonna cost? It's not like you're gonna work for us for free. How much you're gonna involved to just kind of get started. So what's your starting point? Because at this moment, it's July 2025. If you're just talking, then nothing gonna happen. So what's the next step if we are seriously thinking about it? So how much is the cost? We're talking about money because we want to do this for, obviously money. So how much is our investment, time wise, money wise? Can you answer that for me?
Certainly. And I think that's a great question. I'm glad you're asking it. And the first one was, is there an evaluation process? Yes, there should be, and we should determine the criteria of what practices are that should come in. We will make a recommendation to you all to say, hey, this is what I think fits. We should be working with practices that are over X dollar threshold and have X amount of EBITDA. And I can tell you, it
EBITDA,
mostly would make
okay.
sense for practices that have greater than $1 million of revenue, but there are exceptions for those that have a little less. We'd also tell you that we'd be seeking practices that have greater than 10% EBITDA and have the potential to get higher than that. That would be flushed out in the first step of the process, which is the accounting exercise, which is doing what is known as a quality of earnings, which is a sophisticated accounting financial model to determine the EBITDA. And this has to be underwritten in a way that a bank will recognize it. And so it has to be done in a certain process that we've done hundreds and hundreds of times for our groups. I believe that within 60 days, we would have an understanding of if all the practices that chose were a fit, and we'd be making a recommendation immediately thereafter to say, these 10 are a fit, these 3 we would want to reconsider or put them back on the track to working on things before they came in. To answer your question about cost, the cost for this, you're right, it is not free and it's not cheap. But that's because we're creating tens and tens of millions of dollars of value in building a new company. We're taking practices that might be worth 5, 6, or 7 times EBITDA and making them worth 10, 11, or 12 times EBITDA and putting a lot more fuel behind that fire along the way as well. In theory, everybody that comes into this process should be tripling or quadrupling the value of your individual practice by becoming part of this process. But for Aligned to run this process with you all, we would charge a monthly management fee, which gets you the underwriting, the quality of earnings, and all of the team that we have behind us to support you through this process. And it allows for folks to not have to commit to anything other than being a part of the process. Once we reach the end, which would be somewhere between 9 and 12 months, you would make a decision as to whether you were ready to merge your practice into this DSO. If you've gone through the underwriting, you've gone through the legal design, and you've gone through the integration of the basic management systems that are required, you'd be then in a position to say, okay, you'd have legal documents in front of you, and you would say, yes, this makes sense for me to become a partner in this. I will merge at this point. At that point in time, we'd earn a cash fee and most likely a stock fee, depending on if you wanted us to be a partner with you in the business. In most instances, the clients that bring us on board ask that we stay in some partner fashion. And so some of our fee could be converted to equity at that point. And so we take that and, we allow the client to make that decision if they want to convert so that we're part of your company with you. If you've learned over the 9 to 12 months that you like us, that you know us, that you trust us, and that we know what we're talking about. Otherwise, you can just pay a fee and that's paid by the bank when we recapitalize you. The monthly management fee is going to be a couple $1,000s a month. I need to understand the size of the practices, how sophisticated the accounting is, and how in-depth my team is going to need to be involved to do the underwriting. The fees that are paid at the time of capitalization is a couple percentage points of the value of the company that we put together for the cash portion, and the stock is something similar. We're happy to put together an example for you to show you how it works.
Really, most of that monthly fee is getting absorbed by the underwriting costs for us to work with accountants that could go do but really the exercise that's happening is we're doing diligence on each practice so you guys can say, hey, this is what I'm investing in or buying in together. So we can get you guys and follow up more of a real proposal to say, here's the subscription for each person that would participate in it. And really, they're only paying that monthly fee so long as they're kind of pursuing the process and working towards a close. The success fee is paid upon the successful outcome of kind of the project that we're putting together. It's not paid specifically in cash by any one of you. When we go refinance any small practice loans that exist or equipment loans, we're also going to be looking to bring you guys a bank that will give you a large line of credit. That line of credit will be used to cover any transaction expenses or legal expenses for the company, but really fund future acquisitions so you guys have cash to go grow, or even potentially allow for some liquidity at day one if we decide as a group that partners want to take some chips off the table right out of the gate. We have to look and see if that's viable. And we haven't had a discussion with Dr. Harrell, with the partners in the group, to say, do we like that or we not like that idea? But there's a variety of options that can exist for different types of projects. So what we'll be doing is saying, if this is something the group says we really want to try to move forward with this in a real way and start looking at each practice and underwriting them, we would get you guys a proposal to say, this is how we would get involved and the per member cost.
And the fee started, I'm sorry, the fee started when you do the analyze, right? When the exercise, you said, starts.
Yes. And if a practice pulled out of the process and said, hey, we did an analysis, and while we're working with you, just be clear, Dr. Harold and also the Align team is trying to work with your practices to grow your EBITDA. So in most instances, you will make more money through the process, because now we're going to start trying to work on reducing costs, increasing reimbursements, centralizing expenses, like all the strategic things in the power of the group, and just elevating from what we have today. And so if we're effective, and once we really get in there and look at some of these numbers, it's not uncommon you're making a lot more money while you're pursuing the project than before you even came in. And like we said, we really would like, Dr. Harold said, he'd like to be working with the clinicians on getting the practice to kind of fit that box. And so there's value add for that.
So you said it costs about a couple thousand, let's just say $2,000 a month. So it's paid by individual. I don't get it. It's paid by individual practice, or
yes, each of the members that are participating in the
company.
So let's see, my office take 6 months, and I just pay 6 times whatever. But so let's just say other offices, they finish in 3 months, and we're waiting together, right? So the evaluation, because every practice may take different time. So that means if I join it, I just get charged every month. Is that what it is? Until
not
the company
exactly.
established.
So there's different phases. Like the first couple months, we're going to already have been able to tell each of you whether this economically made sense, and should identify what the economics are for each person. Once you get to the third and fourth month, now we're working on the integration, refinance, the legal structure and strategy. And so what we're saying is early on, in 60 to 90 days, we're already going to know whether it even makes sense to continue pursuing. So any of you on an individual basis are going to learn an immense amount of information about your practices from a financial review and underwriting to say, this is where we can grow, and this is kind of some of the benchmarks and how we go improve it. But typically there's a monthly subscription fee as we go through the process. But really, we're working towards trying to get you to an outcome, which would be a successful closing with the right structure and the right participants.
One of the things that we've done for groups that come together when we go and raise the capital to refinance the debt is to refund the practices the management fees that they would have paid. That's something that we can get done with the bank. And it's really up to you all, because it's just an extra amount of debt that provides a refund for those that came through the process and got to the end successfully. That's something that absolutely can happen. And we can show you exactly how to make that work. That should give folks a little bit of an easier thought process about joining this. And I can explain a lot more about that if that is interesting to you all. Let's say you all participate in the process for 9 months, and it costs, $2,000 to $3,000 per month per practice. And we've gotten through that. A practice that, paid $27,000 for the 9 months that they were into this process, and they successfully got there. We need to, and you chose to merge into the DSO. We need to go to that DSO and get capital to pay the existing debt and refinance any debts that exist on the practice. We can get additional capital from the bank to provide some amount of liquidity back to the practices. And if that is one of the uses that we'd like to do as a success fee trigger for those participating members, in theory, we could do that and provide that money back to those participating members at the time the company was capitalized.
So let's just say if we merged, finally we got a group, right? The DSO established. Do we have like hiring, for instance? Because that's what we are, struggle with, the staffing issue. Is that the company gonna, manage the hiring process, provide the benefits, all those kind of things? Is that what it is?
That's exactly right. You're now a DSO that now operates. You no longer are an owner of one practice. in theory, you're now an owner and partner in 20, 25 practices. And with that, we now have the budget to manage and maintain recruiting, HR, onboarding, benefits, and all the other things that go into the administration with the employees. That's all provided by the DSO. And whether Aligned does that for you or we help build the management team for you, the DSO is now obligated to provide those services. That would be, you would be unencumbered from that as a partner and owner of this company. We'd have a team that would be doing that on your behalf.
And for one
Even
other
with the
example,
payroll, right? Even with payroll.
Absolutely. Down to
Will there be
payroll,
one
down to
So, but
paying,
we're
paying you, your doctors, your associates, the staff, all the payroll.
like even we're in different states, we have like rate. For instance, like hygienist, the one state maybe $60, the other state maybe $80. So
We would never suggest synchronizing their pay. However,
oh, okay, I see.
the company will pay their paycheck for them. Every employee that is part of your practice and all your partners' practices, we would suggest leaving them all in the exact pay structure that they're at, except now they would get access to health insurance if we don't provide it today because for
Right. Uh-huh.
all the laws and requirements of that, and their
Mm-hmm.
benefits increase. But we wouldn't synchronize the hourly rates of pay.
so what we're saying is we
Okay.
would have
Right.
one arm of the new group that would handle processing payroll for all of you guys and doing it on your behalf. Another example is each of you might work with different bookkeepers and accountants that do the monthly P&Ls. Well, we get big enough, we would have one bookkeeper or one accountant or CPA for the entire business. It's cheaper than 20 individual people paying individual bookkeepers. And now they work full time just for this group, handling the accounting and the doctor payroll calculations and budgets and banking and everything else. There's going to be economies of scale that come with centralizing a lot of these things. And so we're helping to build a platform to take a lot of things off of your plate and support them centrally by combining resources.
So you said you have helped establish DSO. Can you give me the name? So who, like I can do some research to see, because this it sounds like very complex.
We would be happy to provide a list of references. We can give you, say, here's some people to speak to and provide some color and context. We've done quite a few projects, so that would not be challenging.
Okay, that's I think you should forward it to Harold, but I was just wondering, because yeah, it's like it sounds like very complicated. Okay, to me.
So we've developed a playbook for this, right? So like when we're talking about these things, we go through a process, and it's kind of some things happen in sequence, some things happen in parallel. So the first thing is this review of each of the practices, and then we start building the playbook for the DSO. And when Chris showed you that exercise that had how to get it to investment grade, and there were kind of like 10 buckets, that's what has to be created to help you guys have a platform. So we kind of know what the raw ingredients are. We know what needs to be set up at minimum to combine. It's a legal structure. It's an accounting and cash management platform, a banking relationship, and it's an HR platform. We can wait later and integrate software. We can later integrate some of the vendors. And we'll walk you guys through the quote unquote playbook on how to put together a group. But the key start is to figure out how do we get some people at the starting line that want to embark on the process and the journey and that are serious about it. And we do a fast and thorough review of their practice financials and say, what does this look like if it all combines, and present that and make sure that it works for everyone. And then start to set the kind of what we call like the rules of engagement. How is this group going to operate going forward if it closes? And how does the group add value to the individual practices and new members that would come in later?
Okay. Thank you.
Sure.
What other questions can we answer? This is great dialogue.
Hello.
Good evening.
Hi. Can you hear me?
Yes.
Okay. My name is Dmitry, and I heard whole course. So basically, you are offering is a centralization of the financial ruling and whole stuff. But the question is, how it's going to be working in real time? Because, for example, one state, one law, Ohio, some Massachusetts, it's going to be different laws, and it requires uh, more involvement of local stuff. So that will be different CPAs, different billers.
Yeah. So I think the question is relating to the complexities of bringing a company in that is operating in multiple states.
Correct.
What we do, and we've done this dozens of times, and this is how every other DSO in the country operates. There are certain clinical assets that are left behind at the state level or at a clinical entity. For example, all the doctors are still going to be employed at the existing practice level location that you have. Non-clinical employees are employed perhaps at the DSO level. We need a separation of non-clinical and clinical assets and clinical employees. We operate now with one benefits company that dupes out and replicates a benefits package across 2, 5, 10, or 50 states. And this is how large companies operate. They get one benefits package that's serviced across that many different states. One attorney would represent the entire group. And there are no less than a dozen law firms that work in this space. And there's 2 or 3 that we generally prefer to work with. And they would represent the company and all the members in all the different states. Most of these are licensed to practice in all 50 states and have the ability to write agreements that comply with every state out there. There's malpractice insurance that the company would underwrite, and it's done at the state level. And so those policies are underwritten but look identical from one state to the next. The complexities of a payroll across multiple states are actually rather simple when you use a more complicated payroll management system, a more robust enterprise level operated by a payroll specialist or what's known as a PEO, professional employment organization. That's specifically what they focus on is employing team members in multiple states. And so with each section of the business, there are just a variety of rules for how to operate multi-site, multi-state businesses. They're a little less complex than one might actually think, and this is how every DSO would operate that exists in the country, of which there are about, I think, 400 DSOs that have any size or significance in the US that operate in a similar fashion.
Okay,
The
okay,
environment's
thank
not
you.
a problem. Yeah, so we just have different PCs at the state level. There's going to be some different legal governance by state. And so we just need to make sure that non-competes and employment agreements and everything check those boxes. But that won't really have a huge impact on the overall structure.
Okay, thank you.
Sure.
Certainly. We're happy to stay on for a few more minutes if that's helpful to the group. Or we can give you all your time back to get back to your evening or talk amongst yourselves as a group. We're happy to do any of the following, but we've really enjoyed our time with you all here this evening. We hope this has been informative and changed your thought and perspective about what the path could look like for you. And how there is a way to go form a DSO without having to sell to one and rapidly transform the economics of your practice and create a legacy company while doing it. We'd be very excited to work with you in this project and help support and guide you in any way that we can.
The last thing I'll add with is we're very good at helping you land the plane. So we can take it from concept or idea and go really fast to help you guys get to something that's real and tangible that you guys have executed on. And so we got to have the raw ingredients here right now. Right? We just need to be able to look at the practices and actual numbers and data. And we've heard that message from a lot of different members saying, hey, we want to know that we're going to do it. We want to know what that means. We want to actually have the decisions. And so our role in the process a lot of times is also to quarterback decision making to help you guys get to a clear outcome really, really fast. And for some of you, it's identifying it's worth doing this or you shouldn't do it. And so if 50 people start at day one, we mentally land with 40 or 45, then it makes sense because sometimes not all practices are going to be the perfect fit. But we'll welcome continued, dialogue with you guys in the process. We'll certainly follow up with Dr. Harold as you guys meet amongst yourself and figure out if this is something that, we can support going forward.
Well, thank you, Chris and John. I think you guys give us a lot more insight, and you guys help to answer a lot of questions. I think it's always better to have somebody else answer the question because you guys been doing this many, many times. And then, like you say, it's not an easy process. We have already gone quite far. And then, like Chris also said, historically, dentistry is true. I mean, I look at the business of health space. Dentistry is always 10 years behind the medical. There is no more solo practitioner in the medical anymore. Okay, everything is MSO. Okay, if you don't belong to an MSO, you cannot you cannot practice. Period. Okay, so that's just how life is going to be. The question is, are you going to wait until the end to get this thing done, or you want to do it in the beginning? Just like I talked to someone that came by yesterday from a rep. She bought Bitcoin when it's $65. Okay, so she started early. Okay, she bought a lot. So sometimes we get lucky. The process is always difficult. You have to have a vision for it, and nobody have the crystal ball. But the fact of the matter is, we know dentistry is always behind the medical, and that's just the way it is. I mean, I see it many times. Some of my friends, they're lucky. They start early, and then they captivate the benefit, like you say, the equity pool, the owner's pool, the founder's pool, and they get paid 3 ways, 4 ways, or 5 ways. So that's basically, sometimes they get lucky, and then but the reality is everyone have a different outlook, and our goal is really to help all of us. Hopefully all of us will get focus, and then those who really want to participate, want to take themselves to a different level. Just like working out, you have to commit something, you have to go through a little bit of a difficult exercise, but then in the end you have a much better path than what you would have seen just like opening your own practice, instead of just work for somebody else. So thank you, Chris. Thank you, John, for your time. And if there's any more questions, I guess they will forward me some question. You guys forward see whatever the question, and then we'll go over it. And maybe if you guys were lucky enough to bring you guys next time, then they might have more specific questions for you.
We look forward to it. Dr. Harold and team, is a pleasure. Thanks so much for having us on tonight, and we look forward to next steps.
Thanks again. Look forward to it.
Take care.
Thanks, guys. Take care.
Thank you.